Hi, I'm Jim Griffin, Investment Content Manager at Columbia Threadneedle Investments, and welcome to another episode of Credit Threads, a special fixed income podcast from the Eye of the Needle team. Credit Threads takes a regular look at macroeconomics, central banks, inflation, and their impacts on credit markets. Joining me for this episode are Gene Tenuzo, Global Head of Fixed Income at Columbia Threadneedle, Alistair Ross, Head of Investment Grade EMEA at the firm, and my co-host Chris Morton, who is a Fixed Income Client Portfolio Manager. Welcome all. Now today we'll talk about expectations for the second half of 2022 after a pretty tumultuous first 6 months. But Chris, the last time we got together, we discussed how there were very few places to hide in fixed income markets. Is that still the case, and how unusual is the market performance we've seen so far this year?
Hi, Jim. Yeah, it's been pretty unusual, is the short answer. And really nothing has worked, including diversification and those assets that investors have in their portfolio that typically serve as a portfolio volatility buffer, such as bonds, fixed income. The broad bond market was down about 10% in the first 6 months of the year. And that meant that even a balanced portfolio, a portfolio made up of 60% equities and 40% bonds, was down around 17% in the first 6 months of the year. So that actually is the worst performance we've seen since the late 1980s. So it really was a very interesting first half of the year, and I'm sure investors are very confused as to what is going on and why we're having this correlation breakdown where nothing is working. And what's really interesting is that the assets that are the most conservative, so those that are more sensitive to changes in interest rates, like investment grade corporate bonds and government bonds, really took the pounding. And that's what we saw happen broadly across markets where, more of a duration sensitive sell-off than just a credit sell-off.
Yeah, so tough times indeed. I think it's hard to square the quite positive employment picture and consumer strength when looking at leverage and income ratios with the dire performance we've seen in fixed income and indeed equity. I mean, is it fair to say then that the central banks fighting to dampen inflation are actually the root cause of the pain we're seeing now?
I would say the short answer is yes, that's pretty fair to say. Inflation is the root cause because it's been significantly above the Fed's 2% target. And what the Fed fears is that high inflation will actually become embedded in the economy through factors like high wages. And so the Fed is as focused on actual inflation, like what we're all feeling at the gas pump, as they are about inflation expectations. They don't want to see people believe that this inflation is going to be persistent and that they will not be successful in getting a lid on it. And as you mentioned, the consumer is really strong and continues to be on a top line basis, like metric basis. So debt service ratios and leverage, for example, are still pretty positive on a long-term historical basis. And that's exactly what bothers the Fed. And what they're trying to do is create demand destruction. And one way they do that to bring prices down is through raising interest rates. And that's what we're all sort of bracing ourselves for here and trying to anticipate how fast the Fed will move, how aggressive their increases will be, and the impact that will have on the overall economy, growth, inflation, employment, and all those metrics, those macro metrics that we follow as investors. And so with that, I want to pose the question to Gene. What are the red flags in the U.S. economy today and the variables that you believe are yet to turn to sort of put a defining note on whether or not we're facing recession?
Yeah, thanks, Chris. Indeed, there are red flags in the economy. But before we get into that, I think it's important to frame our starting point. In the U.S., real GDP last year was 5.7%. That's the highest since 1984. So very much a strong rebound as we were coming out of a very sharp contraction from the pandemic. The starting point is strong, both for consumer balance sheets and for corporate balance sheets. But we also have to remember that we are seeing headwinds naturally before we even think about the Fed. So if you look at the fiscal contraction, basically the lack of government provided help going into this year, that is a meaningful headwind, almost 4% of GDP. This is from the simple math of the government no longer providing stimulus payments to households and subsidies for business loans, et cetera, this year. So there's a natural fade effect, a natural headwind from the lack of fiscal policy. Then we look at monetary policy, Chris, and you mentioned the Fed tightening financial conditions and demand destruction. Demand destruction is a term we should be frightened about, because that does mean that in an environment where you have an inflation problem because demand is above supply, and the Fed realizes it cannot create supply of particularly goods that are in scarce supply like oil or like semiconductors, all it can do is bring down demand. We can see that evidenced in areas particularly that are the most interest rate sensitive, like the housing market or the market for new cars. And indeed, we've seen the housing market slow, but I would still say when you look at house prices in the US that are up 20% year over year, you're coming from a very high point. So we've seen signs that the housing market is decelerating. I would say that was evident perhaps at the beginning of the year. What we're seeing more recently, particularly in the second quarter, is that the consumer is starting to feel the pinch elsewhere. So if you look at the consumer as the largest part, more than 2/3 of US economic activity, what we see is that the lower income consumer is really feeling the pinch, particularly from higher energy prices, higher food prices at the grocery store. And also, if we think about the higher income consumer, there we've seen a historic amount of wealth destruction that's come from equity markets and bond markets, as you just described, declining pretty meaningfully to the tune of $15 trillion with a T of global wealth destruction this year.
Thank you for that. And, you know, the volatility has really been just off the charts. It's a day by day experience for us as investors. So what does all this ultimately mean for the Fed, their path, and the pace of hikes from here?
Well, if you think about where we sit today, the Fed has a mandate that looks at maximum employment and price stability. With the unemployment rate below 4% and inflation above 8%, it's a one-way street. There is only one thing the central bank can do, which is try to tighten those financial conditions and, of course, raise interest rates. That is the path they are on. The challenge is that monetary policy acts and affects the economy with long and variable lags. So we can look back to as recently as March of this year, when the Fed was still easing and had interest rates at zero. That was only about one quarter ago. And here we are today. The Fed has raised rates rapidly and has signaled that it will continue to do so. It just hasn't been long enough yet to see that impact on the real economy. So the Fed has a calibration challenge on its hands. And I don't think there's really a perfect way to know how much they have to raise interest rates in order to slow the economy. And at the pace that they're going, there's a significant risk that they perhaps raise rates too far, and the demand destruction is perhaps greater than they would have liked. So that calibration is a significant challenge. The anchor that we have today is that the Fed believes that a neutral interest rate is somewhere around 2.5%. We expect the conversation will evolve in the third and fourth quarter of this year in terms of how far into restrictive territory they really need to go. Our best guess is they want to at least signal that interest rates will move to the 4% level. We're not sure they'll be able to actually get there, but I think that's the way they want to guide market expectations at this stage.
So, Ali, turning to you, is the expectation much the same in Europe? I mean, given the dependence on Russia for energy and then the EU's subsequent plans to wean itself off that supply, if anything, it seems like the inflationary pressure and challenge for central bankers in Europe is possibly even greater.
I think that's right, Jim. I mean, most of the dynamics that Gene outlined are true for Europe as well. So supply chain pressures, whether it's semiconductors, energy. But, the big difference really is that the energy component is much more front and center for Europe. And as a result, yes, more inflationary pressures, but these are supply side inflationary pressures. So when you think about, a central bank and it's trying to, set the appropriate interest rate for the economy, the interest rate is a tool that can't fix supply side issues. It can, is applied to the demand side. So the European economies and, the UK, have an inflationary, problem, but actually it probably will manifest itself more as a growth problem. So, energy prices are very high. That's a cost of living crisis for consumers. For places like Germany, the feedstocks, prices go up a lot. There's can be a real crisis in German manufacturing. And so I think as a result, as we go into the second, half, the ECB is, as we stand today, firmly focused on inflation, just like the Fed. They don't want inflation expectations to get out of control. But because we have this, energy price issue and the impact that's likely to have on cost of living and on manufacturing, it might be that the ECB and the Bank of England find it more difficult to raise rates in that environment, and also that the inflation that they're facing is more supply side than demand side at any rate. So we'd expect there to be kind of more focus on the growth picture in Europe, as we go into the second half.
Gene, let's talk about balancing the myriad of risks that you're facing right now in a multi-sector portfolio. Do you feel that this opportunity now where yields are represents a good entry point? Has the sell-off been linear? Like, do you see high yield as valuable as IG here? Or do you think there's more pain yet still to be experienced?
I continue to think there will be volatility, Chris, through the remainder of the year, but I don't think that the market volatility has been linear. And in particular, what we've seen is this is a sell-off that has been driven